Welcome to CoreLogic's update on housing market conditions for December 2019, brought to you by First National Real Estate. The housing market recovery has continued to gather some pace through the month, with our national index up 1.7% last month, delivering the fifth consecutive monthly rise, coupled with the largest month-on-month gain since 2003. The latest update takes national dwelling values back into positive annual growth for the first time since April 2018. Since finding its trough in June earlier this year, the National Dwelling Value Index has recovered by 4.7%. Although values are recovering rapidly, at a national level, home values remain 4.1% below their 2017 peak, tracking roughly at the same level as they were in January 2017. Sydney and Melbourne continue to drive the rapid recovery, with values up 2.7% and 2.2% respectively over the month, while each of the remaining capital cities, apart from Darwin, recorded a rise in values over November. In a significant turn of events for the Perth market, values edged higher in November. That's the first month-on-month rise in dwelling values since the downtrend took a pause in early 2018. Dwelling values have been trending lower since the mid-2014s, down a cumulative 21.3% through to the end of November. Over the past 13 years, Perth has seen house values move from being amongst the most expensive across the capital cities to now be the lowest. Great news for first home buyers. However, Perth homeowners have seen a material reduction in their wealth over the past 5.5 years. A variety of factors are supporting the strong gains in housing values. The synergy of a 75 basis point rate cut from the Reserve Bank, a loosening in loan serviceability policy from APRA, and the removal of uncertainty around taxation reforms following the federal election outcome are all central to this recovery. Additionally, we're seeing advertised stock levels persistently low, which is creating a sense of urgency in the market as buyer demand picks up. There's also the prospect that interest rates are likely to fall further over the coming months, and an improvement in housing affordability following the recent downturn are other factors supporting a lift in housing values. While housing values trend higher, rents are sluggish. Across the combined capital cities, rents were unchanged in November and only 0.4% higher over the past 12 months. Softer rental conditions can be attributed to a range of factors, including the recent history of rising rental supply, demonstrated by unprecedented levels of investment participation in the housing market between 2012 and 2017, as well as a significant increase in dwelling construction skewed towards rental accommodation in the high-rise apartment sector. Additionally, a larger than normal number of renters have transitioned to first home buyers, thereby denting rental demand. Melbourne housing values were 2.2% higher over the month of November, taking values 8.3% higher since the market bottomed out in May earlier this year. Melbourne home values are now only 3.7% below their October 2017 peak. At the current rate of growth, we're likely to see the Melbourne home values reach a new record high over the first few months of next year. House values are rising faster than unit values across Melbourne, up 8.6% since bottoming out, compared with a 8.1% rise in unit values across the city. Stronger capital gains are concentrated within the upper quartile of the market, where Melbourne's most expensive 25% of properties have recorded a gain of 11% through the recovery phase to date, while values across the lower quartile are up a smaller 5.7%. The Australian housing market is now 5 months into an unexpectedly strong period of recovery. The question, of course, now is how long can such a fast pace of capital gains be sustained? Annualising the growth rate over the past 3 months implies the national index is already tracking well above double-digit annual growth, while Sydney and Melbourne dwelling values are tracking around the mid-20% range for annualised capital gains based on the most recent 3-month period. Considering wages and household income growth remain low, economic conditions are losing momentum, and housing affordability is once again worsening from an already high base in the largest capitals, there is likely to be some headwinds in maintaining such a fast rate of recovery. Additionally, the market is yet to be tested on higher supply levels. Advertised listing numbers have remained seasonally low throughout spring due to a low number of new listings and an increase in the rate of absorption as buyer demand lifts. With selling conditions looking very strong, there's also a high probability that listing numbers will show a material lift throughout the first quarter of 2020, which will provide a test of the depth of the market and potentially ease some of the urgency that's contributing to higher prices. Smaller cities are starting to show a stronger growth trajectory in the housing market, including Perth, where housing values have been trending lower since mid-2014. As housing affordability becomes more pressing, jobs growth fades and unemployment ticks higher across New South Wales and Victoria, the smaller capital cities may be beneficiaries of increased demand. Based on data to June from the Australian Bureau of Statistics, there's a clear trend towards stronger interstate migration rates into Queensland, as well as a reduction in the interstate outflow from South Australia and Western Australia. More affordable housing options across smaller cities is likely to be attractive to interstate residents. However, jobs growth and the unemployment rate is generally weaker relative to the larger cities, which remains a barrier to higher housing demand. With interest rates likely to track lower in 2020, we could see additional stimulus counteracting some of these headwinds. Mortgage rates are already at the lowest level since at least the 1950s, which is one of the main factors supporting an increase in market activity. If rates do move lower, no doubt policymakers will be watchful for any triggers that could provoke a policy response limiting housing credit. Previous rounds of macroprudential policies have had an immediate effect on slowing the housing market activity. As the housing market quietens through the festive season, we expect activity to ramp up in February. You can stay up to date with all the housing market news at www.corelogic.com.au. No doubt the new year will provide just as many twists and turns in housing market conditions as 2019 has. Until then, have a safe Christmas and Happy New Year.